Hi, I'm Keith McCullough. Happy New Year, and welcome back to Tweet Keith, which is effectively where you give me your questions, and I pick the top 3 questions that are relevant to your market day. So let's just get into it with the first question from a huge Hedgeye fan, I might add, Ivan the K. And the question is, when will rates impact equities? Now, the premise of the question is actually what I don't agree with. So, and that's not new, actually. A lot of people thought that as interest rates went up, people would get freaked out in the stock market and stocks would go down. Now, in fact, quite the opposite happened, and I'll tell you why. Number one, growth expectations rise alongside rising interest rates. So rising interest rates, in terms of what just happened, was a very good thing. GDP growth went from 0.14% in the fourth quarter of last year to 4.12% in the third quarter. Just a fantastic run in growth expectations when most people weren't positioned for it. So that's point number one. Point number 2 is that stocks go up when growth expectations go up. So that's an obvious one. And point number 3, which is probably the most exciting one, is that bonds go down. So in other words, when you get rising interest rates, people who are long bonds, and a lot of people who are long bonds, start to lose money, and they start to take money out of bonds, and they put them into stocks. So that's the fund flow story that is the third part to really why we like interest rates going up when we think about why stocks should and could go up. So that's the first question. Second question is from a very thoughtful investor by the name of Bill Peterson. Now, this question is about break-evens, which is an interesting topic for institutional investors, and I believe Bill is. Rates rising as inflation break-evens rise. Bad for gold? Now, that's more of a question. So break-evens, you could see this today in Hedgeye's chart of the day. We show a 1-year break-even. Now, break-evens, the reason why most institutional risk managers look at break-evens, it's an explicit signal for inflation expectations. So that's been rising. You can see that in our chart of the day. But you could also see this in commodities. We've been talking about this. For the last really 4 to 6 weeks, what you've seen is inflation expectations rise in terms of both break-evens and commodity prices. In other words, copper's up about 6% in the last month, for example. Now, again, as these inflation expectations rise, Bill's asking that very basic question, shouldn't I buy gold? Now, to be clear, Bill, it's not proven over a long period of time that buying gold just as an inflation hedge actually works. The only long-standing relationship between gold and anything else is rates rising. So I'm bearish on gold when I'm bullish on interest rates. In other words, today, gold's up. So what did I do? I shorted it because I think interest rates are going higher. If you're owning gold as an inflation hedge, all you have to do is study the 1980s. You had raging levels of inflation and gold started to get hammered. So again, you got to understand that different macro markets move on different things, and this is just how I see that one for right here and now. Now, finally, from Will Hassel, this is a question about a stock. Now, we get a lot of questions about stocks because we make a lot of noise about stocks in both our real-time alerts product and in investing ideas. Now, Starbucks is an interesting one because recently we sold it in investing ideas. So we get a ton of questions about this from our customers because, of course, they were long Starbucks, and some of them still want to stay in it because it is a great long-term story. And to put some context around that, like in real-time alerts, we've owned Starbucks since April of 2009, like at $11.50 or something like that. So the long-term case, to be clear, for Starbucks is very bullish. And again, we're not making that point right here now. It's about the immediate to intermediate term point. So I want to show you a chart on that. And again, you just go right to the Hedgeye playbook, and you can see decisively that the immediate term trade line of support is now resistance for Starbucks. So again, the trade line broke. So that's just flat out bearish from an immediate term trade perspective. And then from a trend perspective, you can see that line underneath at 77.03. That's the trend line of support. Now, the problem with that is that line could break too. And why could it break? Because they didn't have a really good season from a holiday selling perspective. And again, that's where our research comes into play. So in investing ideas, the product, you could see that because Howard Penny, who's our analyst on Starbucks, been in the industry for a very long time. That's his main concern. So if Starbucks, number one, misses the sales number, never mind misses any number because the stock's just been a complete home run. In investing ideas, I think it's been a double versus the S&P versus when we put it into investing ideas. But we took it off because, again, we're concerned about the quantitative setup, which is the trade line broke, and then the research piece, obviously, which is not as bullish as it was. So that's it. If you have any questions about anything, interest rates, gold, Starbucks, please tweet me. @Keith McCullough is my Twitter handle.